So the benefit isn't as great if you're on the lower income threshold. But if you're on the higher income threshold, it still makes a lot of sense offsetting your federal tax only. If you're in a high income threshold, say California, New York City, in these other areas that are high income tax areas, you can have much lower income. I wouldn't say much lower. You can have lower income and receive significantly more benefits because you get both the federal and the state benefit. And if you looked at a no income tax state compared to a full income tax state, let's look at $1 million taxpayer. If you had $1 million taxpayer in Tennessee, we could basically create a cash on cash return up to 166% on the contribution. That would be an optimized contribution for that $1 million taxpayer. And in California, that same contribution could provide a 206% cash on cash return. So that is the equivalent of participating in a transaction that's not tied to the market or the ups and downs of the market, where if you gave me $1, I could give you back 2. That's if you're in a high income tax state. Again, there's a range there depending on the state that you're in, but there is massive planning potential here between now and the end of the year to secure some significant tax savings, assuming you meet the income hurdles that we typically have. And I would say those income hurdles are generally household income of $500,000 or more. It makes a lot of sense. In high income tax states, sometimes we can go lower, but again, that is all forms of income. So if you sold a piece of real estate, that capital gain is included. If you have a business interest, if you have performing assets, rental income, and all sorts of other types of income, we look at all in aggregate and we can offset that in a meaningful way through your participation.
Thomas, that's incredible. Thank you so much. We're going to keep going here. If I could just recap that to try to bring it down to my level as simple as possible. Most people are familiar with if I donate $1 to my church, I get a deduction for $1. Essentially what you're saying is there's programs out there or organizations out there that are set up in such a way where if you donate, let's say $1, you actually get credit back for up to $5 on that same donation. Is that essentially kind of what we're
Yeah,
stating?
let me just revise your wording just slightly. They're contributing capital to the campaign to help fund the campaign. But what they're doing through that campaign contribution is they're acquiring a specific type of asset, and then they're getting that asset at a deep discount to its fair market value. And because of the nature of the asset type, there is no holding period requirement. So they can immediately donate that asset at its full fair market value. And they're basically leveraging the arbitrage between the pricing differential of the acquisition price versus its fair market value. Okay. So that is slightly different. They're not donating cash. They're contributing capital, acquiring a discounted asset, and then they have the ability to donate it at a higher level where its current fair market value.
I love it. Thank you so much for covering that. We're going to keep cruising along here and we're going to go to depreciation, which is our number 4 tax move before the end of the year. A lot of people didn't realize the One Big Beautiful Bill Act that was passed several months ago. This actually changed depreciation back to 100%, specifically for business vehicles. There's a thing out there called Section 179, which is a beautiful section of the Internal Revenue Code, which says if you have a vehicle, use it for more than 50% business use, and it weighs over 6,000 pounds, you can actually take a deduction for up to 100% of the cost of that total vehicle, which is really great there. This can also apply to other business assets. I put in there business assets. People always ask us, is there ways to get creative and write off the cost of our boats and RVs? I'm here to tell you if that's a personal asset, the answer is no. However, this depreciation can apply to business assets, said boats, said RVs, as long as they're set up properly. We utilize the right infrastructure. They're used more than 50% business use. There are some ways to get creative around that. This is really great with cost segregation studies. So this specifically applies to short-term rentals, especially when taxpayers' income's over $150,000 per year. They can invest in short-term rental properties, then do what's called a cost segregation study, which is essentially a really fancy way of saying take the deductions faster than you would normally have to spread them out over almost 30 years. With the changes with the whole One Big Beautiful Bill Act, it changed it back to 100% depreciation, which prior to that, it was going to be set at 40% for the year. So that's a big one right there. That's our number 4. Smart tax move.